Raymond James is upgrading Aritzia to a buy and outperform. We're joined by the analyst Michael Glen, and he's been crunching numbers on the impact of tariffs, US tariffs on this company. Michael, thank you very much for joining us. Really appreciate it.
Yeah, thank you for having me, Andrew.
So you've been, just to set the stage for us, a lot of Aritzia's clothes would be made in China or Vietnam or Bangladesh or places like that?
So from what we understand for the supply chain, somewhere between 45 to 50% of the product is made in Vietnam, and about 25% is made in China.
Right. And now you've crunched the numbers and you think that the gross margin is likely to come down by about 2.5 percentage points, partly because suppliers will absorb some of the cost. And I know this is very broad and you provide a very detailed calculation here, but a hit of 2.5 percentage points on the gross margin, how damaging would that be for the company?
So overall, what I would tell you is we've taken into consideration all of the tariffs that have been announced so far, and the total impact, and I'll just frame this out because this is what's outlined in the note, is about 500 basis points, a little over. And we've assumed with our own model adjustment that Aritzia absorbs about 250 basis points of that pressure. Now, there are levers available for the company. Pricing is a big one. Stemming from this, we estimate that a 5% aggregate price increase in both the US and Canada, so across the board, would be able to offset the gross margin dollar pressure from these tariffs.
We're looking at the stock. You had it as a hold or a market perform previously. What were your concerns at that stage, Michael?
So if you go back to early January when we did downgrade the stock to hold from outperform, our concerns at that time surrounded valuation. The stock was trading at an elevated price to earnings multiple, and we knew that investors had a very positive view on the fiscal third quarter report. What happened was the company actually put up numbers that were and provided guidance that were well ahead of expectations at the time, and the stock continued to rally. So if you look at the top line momentum trends for Aritzia, those that are indicated by the Bloomberg alternative data, the top line has continued to do extremely well for the business. What has taken the stock lower is the tariff concerns and the margin concerns, but the top line momentum appears to be very much intact for this company.
What about their growth, though, in the United States? I mean, that's where people are hoping for the earnings expansion in years to come. If America does go into a recession or at least muted economic growth, presumably that would clip their wings.
So at the end of last reported quarter, they have 59 stores in the US. They continue, from our own view, be very underpenetrated in that market. There's a tremendous amount of store opportunity for them to open stores. And one of the big takeaways coming out of last quarter was the traction and momentum, the brand momentum that they're seeing in the US. So they are very far from a saturation point in the US right now. So yes, there is absolutely some concern to take into consideration from a recession standpoint, but it would appear to us that the supply-demand dynamic rests in their favor at this point in time, given the number of stores in the market and the potential for them to grow.
Where do they fit in? I mean, who would be their arch competitors in the United States? Or is there a chain that's analogous to Aritzia?
There's a number of different competitors that you can think about. I don't know if any of them directly align. So Zara, H&M would definitely be spoken about as competitors. You also have on certain product categories, you can think about Lululemon as well. So there's a number of different competitors across all categories. Abercrombie is one that we frequently are asked about with our work. So a number of different competitors to think about.
That's interesting. I'm just looking at your earnings estimates. I mean, you're staying pretty close. You're not changing your 2025 estimate too much. $1.84, you cut it by 1 cent. Then for next year, you were at 262 a share, and you're bringing it down to about 227. So they're not massive profit estimate cuts.
And following on that, I would just make the point that we do believe that there are levers that they will be able to use to offset the earnings pressure that we have factored into our model. So that's something that we do think is important to mention as well.
And can you tell me, I should have looked this up before, have they looked beyond North America? Are they looking at Asia or Europe or anything at this stage that you've heard of?
That was discussed on the last conference call. And it did get some attention. So one of the efforts that they're working through right now is organizing their e-commerce site to better serve international customers. They do not have a proper structure in place. That's something that we believe will be in place by the end of this year. And then the path to opening a actual new store overseas, that is, I would say, in the cards, but they haven't given us a specific timeline for that. The focus right now is in the U.S., opening stores in the U.S. That's where they want to focus their efforts.
Michael, we better jump. Thank you very much indeed for joining us.
Thank you.
Michael Glen, Managing Director at